Got Mark Matthews joining us from Bank Julius Baer. I think we also have Manish Singh, CIO at Crossbridge Capital LLP. Gentlemen, good to have both of you here. Thank you very much for your time. Just a quick word on the data itself. These are just 7 instances, but Manish, what's your sense? How are you looking at it? And do you think a breather is due?
Sorry, I got cut off a bit. Are you talking about U.S. Treasury yield here, right?
Yes, I was, and I was gone. Yes.
Yeah. So, one thing we can all conclude that, what's happening in Treasury market is unusual but not surprising, because if you look at the BIS report and Bank of International Settlement, they have been pointing about the consternation in the Treasury market. They are highlighting the amount of shorts on Treasury, at least on the 2-year maturity. But everything that's happening on the long end is clearly being driven by higher for longer narrative. And now I am not in the higher to longer narrative. I have said this before as well. I think disinflation will be the problem very soon. And I was not surprised when you saw I don't remember who, but I think State Street came out and said that there'll be 200 basis point cuts next year. So on the long end, clearly, it is being driven by this expectation higher for longer, and TLP is suffering. But on short end, it is my opinion from what I've heard and read is that you have a lot of trades being filed on the short end. So I will not be surprised if we have a 2020-like scenario where you could have a volatile move in the opposite direction. And I hope it will be managed well, but that's the fear. If you look at the Treasury market, the way it is behaving like equities in many ways, as you have seen the level of vol. So it should not be surprising, given the market structure keeps changing all the time, but that's what I'm looking at. However, if you are a medium-term investor, you don't have to be concerned about. But if you're leveraged and short-term, then you should be concerned about that.
Mark Matthews of Julius Baer is also with us on the show. Mark, thank you very much for joining in. The historic run on the U.S. 10-year yields continues for yet another day. Where from here, according to you?
Our own view is that the 10-year Treasury yield will be 4.5% a year from now, which is obviously below where it is now. So we're not in the camp that we're going up to, 7%, the kind of thing that Jamie Dimon says. But I've been wondering why the yield keeps rising and contradicting what the consensus had thought would be a peak sometime back, about 4.3%. And I'm starting to think it has less to do with inflation and more to do with politics. And we now have a continuation bill in Congress that will last until the 17th of November. After that, they need to pass another bill. And if the Democrats do intend to spend a lot, which does seem to be their intention, this may be the market's way of sending a message to them that it doesn't like that. The higher the government debt, the higher interest rates go, because there's more supply of treasuries. And the more interest rates go higher, the creditworthiness of the country goes down. And ironically, that kind of creates a self-fulfilling prophecy. So in the absence of what I can see of any clear signals of a second wave of inflation, in fact, I think inflation is more benign. I think it's possibly something to do with fiscal spending that has the Treasury yields going up.
Gentlemen, hi, good afternoon. A lot of our viewers look at the equity market very closely, and they're trying to decipher what this absolutely phenomenal rise in yields, what that means for equities. And Mark, if I could start with you on this. Now, the US market is off just 7-8% from the peak. Given this very sharp run that we've had, do you think equities have adequately priced in risks of potential accidents? And do you see any accidents on the horizon? There's some chatter building up about the US commercial real estate market, for instance. What do you think?
Well, of course, back in March, we had an episode with Silicon Valley Bank and a few other banks. And then the story was about these regional banks being faced with a very problematic commercial real estate market, as you say. The problem with these things is not so much seeing them. They're always out there. You can identify them, but knowing when it's going to become an issue. Subprime mortgages were a case in point. I mean, people kind of saw the problem back in 2005, 2006, 2007. The accident didn't happen until 2008. But anyway, you were asking about the equity market. It's totally normal to have a drawdown of around 7 or 8%. The average intra-year drawdown for the S&P since 1980 has been 14%. I actually think we're putting in a bottoming process for the S&P now, and I think that we're going to get a nice fourth quarter. I know that kind of contradicts what I was talking about earlier with the Treasury yield, but I do think that the earnings in the third quarter will be good, excluding energy. They should be up about 3.5% to 5% year on year. That'll be the first positive year-on-year growth for S&P earnings in 3 quarters. And then going forward, I actually do think that the government will get the message about not spending too much, and we won't have a crazy budget, and that will take some of the pressure off of yields.
Okay, so you're not too worried about the U.S. equity market. You're saying maybe it's in the process of making some sort of a bottom. Manish, what about you? Do you see any further risks ahead because of this 4.8% figure that we're seeing on the ticker right now on the yield?
There's always risk ahead. I won't say one doesn't see risk ahead, but you have to look in terms of level. And I do agree that, until now, the focus was on inflation. And now we have stopped talking about inflation because core PCE, if you look at the core PCE number, 1 month, 3 month average is at 2%, which is exactly where Fed wants it to be. And this is not about inflation. I agree that it's more about the fiscal policy and everything that the U.S. government is doing. And if you see the break-even inflation, because on long end, when the yields are going up, we should focus on what's happening to the break-even inflation. The break-even inflation is not moving. So the market sees this. This is not an inflation problem. This is a policy problem. And with policy, as you know, you saw the speaker is out of office last night. So there will be resolution. And if you take that into account, then equity markets are going to go higher. And let's not forget, September is always a seasonally weak month. So the fact that we've had 4% or 4.5% move down is not surprising. That's very much averaged what we have seen in September. And October, mind you, first week of October has always been most volatile. 7 of the 10 biggest drawdown or sell-off has happened in October, and we still have a few days to go in the first week. Not to scare anyone, but October then finishes positive. So my personal view, as I always say, I'm more a medium-term guy. I look at medium-term. From medium-term point of view, I'm not worried at all. I think that U.S. is fine. It's the politics which is making things volatile. But if you're taking approach of medium-term, then you should be a buyer. And again, seasonality tells you that Q4 is the best quarter in the year, and the third year of the U.S. presidential cycle is the best year. So you have a lot of seasonality telling you should be buying the dip. And if you're a medium-term buyer, then you continue to buy and just build up a position.
Would you agree with that, Mark, briefly? Especially,
yes.
I mean, you've been a big bull on India, and a lot of our viewers are focused on what's happening here. This is, of course, collateral damage in that sense, but would you be a buyer of the dip?
I would. I do. I think we will get a good fourth quarter rally, and one issue is the dollar for emerging markets, but notwithstanding that, I concur with everything that Manish said.
Okay, well, I think we'll wrap up on that positive, sort of, soothing words.
But remember, Manish is saying that it's to get through the first week of October. And he says we still have a couple of days to go till we get round that corner.
We'll get through. All right, Mark and Manish, thank you very much for joining us. Great speaking with both of you here.